The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod on behalf of Gold Money, and with me on the line I have Ned Naylor-Leyland of Quilter Cheviot. Welcome to the podcast, Ned.
Thank you very much, Alistair.
I must say there are very few people I would actually give up a nice sunny day listening to Test Match Special to come and talk to, but you are one of them.
I take that as a great compliment. Thank you, Alistair.
You should. You must. As one of the few real specialists in following the precious metals market, you must be finding the current time, well, I suppose, on the one hand, interesting, but also quite tough.
Yes, of course, it is extremely difficult, particularly as obviously with one's dealing with clients, as well as looking at markets for yourself. There's a degree to which making sense of the price action is the complex thing, because it does require an element of financial sophistication to get a grip of what's going on. But broadly, Alice, I do think that what really is happening at the moment is we're bringing forward the denouement of the existing precious metals price discovery mechanism. I know it's sort of price discovery is something which we speak about a lot in this sector, but it does feel very much as though there are some important changes taking place, which will, of course, end up with a re-rating substantially higher once the dust settles.
Yes, I think independently, you and I have come to that conclusion. You produced a very interesting paper, which you published a few days ago, under the title of Gold Update. I think our listeners might be very keen to get hold of a copy of that. Is that on your website?
That should be available through the Quilter Cheviot website. If not, if you Google for it, you'll find it anyway, because it's been sort of syndicated out there, all over the place.
Yeah, good, excellent. Okay. One of the things that's interesting about this is that there is a little more focus than most research efforts on what's going on in London. I know London is part of the scene, but it is actually a major part of the scene, and because there are very few statistics available on London from London. Of course, the focus on paper markets tends to be on COMEX, and I think we're all guilty of that to an extent. But if I can sort of just kick off, one of the statements that you make in here is interesting, and I think if you could explain it a little more for our listeners. We're talking about the gold market being in a state of permanent backwardation from around a year ago. What exactly do you mean by that? And is it? Can you confirm it is still in backwardation, in your view?
Yes, I certainly confirm it's still in backwardation, in my view. I mean, ultimately, there are different measures and there are different interpretations of what backwardation is, whether or not the entire term is backwardated. I mean, I tend to think that in gold and silver, really the front month is the only truly relevant liquid month to be looked at. And frankly, I think that the basis service that's produced by Sandeep Jaitley is really the most interesting and probably the most pertinent way of looking at available metal to borrow in the market. And he has effectively been repeatedly making the point ever since then that both gold and silver are in backwardation and widening and happening quicker and quicker once the front month rolls to the next one. I think the really important thing here, Alistair, isn't so much the specific nature of the backwardation. I think the very fact it exists on any level at all in gold markets is a profoundly interesting point, because of the fact there's such abundant above ground stocks, whether or not they're rehypothecated or they're less than are traded is a sort of slightly moot point. There still are substantial above ground supplies, and the idea that the market that's in that condition should be backwardated, I think, is very interesting and very telling. I also would just point out that I think that the removal of the SIFO number by the LBMA back in, I think it was October, November time last year, I think that was quite interesting as well, because that sort of chimed into this whole feeling that the LBMA market has started to get quite tight. I mean, it's not really very surprising, really, though, that it has, because ultimately you and I both know that the structure of financial markets has become increasingly stressed. very substantial problems in terms of, real collateral sitting behind the system. And it's not a shock that in a system which is, a fractional reserve system, that's a little bit of a run, and you end up with problems. I've just developed this a little further, and the point that I think I'm keen to get across here relates to what's happening to that small amount of physical that sits behind the LBMA currency swap paper market, which of course is the vast proportion of daily volume in gold. And that relates to what's going on with the bars that sit behind that part of the daily volume market. They're 400-ounce bars. They're really designed to be collateral. They're not sort of money in a sense of a sovereign or any such like item. It's really a form of collateral. And under a functioning fiat money system, I'm not very keen on fiat systems altogether, but when they're working relatively well, your expectation should be that gold will sit gathering dust, sort of parked in banks, and really it has no velocity. The physical metal doesn't move. If one uses the word velocity to describe this, whereas under a functioning fiat money system, fiat cash should move around the system relatively quickly, and that sort of defines the health of the consumer market and the availability of credit and all the rest of it. Now, what I think is so interesting at the moment is we've seen a complete sort of inverse flipping of this relationship, which is the small amount of physical that sits behind the currency swap LBMA local London market has clearly become restless. If we're being generous, the velocity of that has substantially increased. You can see this in COMEX drawdowns, in all sorts of different types of bullion inventories moving around a lot more than they used to. So velocity has increased substantially in physical gold, whereas velocity has dropped concomitantly, or rather more so in the paper cash markets, as you can see when you look at money supply in the US. The available money supply metrics that you can look at, you can see that the velocity has just completely crashed, and all that cash is now parked, at central bank level. And I think it's a very interesting dynamic to observe, Alistair.
Yes, I think at the root of what you're saying is that the normal relationship is that gold sits in the vaults, and money substitutes, I'm going back to the days when gold was fully convertible, money substitutes would circulate in its place on the basis that those money substitutes were freely redeemable into gold, so that the circulation was in the paper equivalent of gold, if you like, but not in gold itself. And that's quite an interesting concept, that actually the whole thing has gone upside down and it seems to be working the other way round. I'm not quite sure what this implies, really, but it does certainly imply there's quite a lot of stress, I would think.
I think it's just a good way of clearing up. People, effectively, you touched on this, the first question you asked me, how I'm feeling about it. Well, the answer is when you see price action like we've seen, it's quite easy to pull for the panic cord and say what's going on. Maybe I misinterpreted this market. But when you look at some of the fundamentals that we just discussed, the metal has come alive in a way that has not been the case for decades. And also, when we talk about everything's fine in the banking system and all is well with the world and we're in recovery mode, it just doesn't stack up. When you look at all sorts of fundamental measures, but I do think the velocity of money, obviously the massive increase in money supply, but also the collapse in velocity, this is a very dangerous combination, as you will well know, because should that become mobilized, then there are obviously very profound potentially inflationary consequences from that, which is obviously a primary reason to own gold, far from the only one. But in terms of the way the market behaves with gold, it is certainly the case that on the last sort of 34, that it is major episodes of fear of loss of purchasing power which drive people to hedge their portfolios through the ownership of gold.
Yeah, and so we've got paper money effectively sitting there, not circulating properly, presumably being tied up in financial assets rather than in anything else, which explains the lack of any real progress in the basic economy, because GDP is basically a money total. And at some stage, that money is likely to flood out of assets and go into, if you like, goods and services in the form of driving up prices, I guess. I mean, that's when it'll be mobilized, I think. Is that how you would see it?
Absolutely right. Yes, I think that's right. And I think that it's a rather interesting dynamic at the moment whereby it seems that policymakers are very keen for people to be invested in the equity market, which isn't a surprise because the big conglomerates get access to, the cash in an inordinately inefficient way relative to the consumer. So they're doing very nicely, thank you very much, on a relative basis. So I think that central planners are keen for people to feel as though warm and cozy through their minority, large cap equities, which also happen to yield more than the fixed interest market, the cash market. So I think it's just an interesting sort of dynamic between central planners who are obviously their predominant role is involved in the government bond, the fixed interest market, but actually they seem now keener for one to be in the equity market than one might ordinarily expect from them.
Yeah, absolutely. Going back to your paper, your first chart is of the gold price, and you've referred to the stopping, if you like, of SIFO and so on and so forth, and the number of events that you draw our attention to on that. And then we look at the gold daily trading volume in your second chart. And there's a very interesting statement here. You say, the best information we have is from the Reserve Bank of India, an LBMA member, who states that the OTC market and futures and options are 92 times greater than the underlying physical market. Now, you say that confirms rather what you feel. I think it confirms what I feel about it as well. But we've never really had it defined, have we? And
No, but we haven't had it defined here either, Alice. I mean, really, this is, apart from anything else, a couple of points I'll make on that. The first thing is, obviously, there's clearing statistics from the LBMA as far as you can get with them. Yeah. And there is, I think it's reasonable to say that probably overstates the overall fractionalization in that form. But what I would say about that is while that's the case, I think there's also an important dynamic which I didn't really go into much detail in the paper, but I think it feeds into the same point, which is, well, how do people go about exposure through that part of the market? How do they gain exposure to the gold price, right, either up or down, using the currency pairs market? And the answer is, and again, you can't show this because the LBMA and the bullion banks aren't exactly mad keen on distributing detailed data on their gold trading. But my sense is as follows, which is that the people that go long XAU versus dollars or sterling, in other words, they're buying gold in the currency market, they're generally people who hold that position as a hedge within a broader portfolio, in the same way that we might own physical. But they want to be in something which is relatively liquid and electronically tradable. Now, first of all, I don't think they're at all aware of the underlying dynamics we've just touched on, but I think more important is the point that they're generally going to be fully paid. In other words, they're not using margin.
Right.
Whereas my opinion is that on the short side, that's absolutely not the case. Because, if you're running a hedge fund and you see the gold price start to crash through technical resistance levels, and why that happens is obviously a different point, how we've got there. But once it starts happening, you have effectively an easy trade. And particularly as hedge fund managers consider gold to be a lazy investment, they see it start to behave the way they feel it should. In other words, go back to zero. What they'll do is they will go long USD versus XAU, or effectively sort of shorting the gold price, but they'll be doing it with leverage as well, and quite considerable degree of leverage. Now, again, you can't qualify or quantify that, rather, but I do feel that that's intuitively quite obvious that would be the case, because that's a trade, and people that go long gold rarely do it as a trade. It's just not really the nature of that as a holding within a portfolio, whether it's within a hedge fund or a long-only fund or even a family office. In general terms, if you want to be long, you're going to be long. But a short gold position, I believe, is a speculative trade, and you will generally leverage that up too. So I think that although the 92 to 1 number that is a clearing number that the Reserve Bank of India produced in that long paper, rather interesting paper that they put out. What the exact ratio is, I don't think we'll ever know that, Alistair, but I think it's an interesting conversation to have, and I'm damn sure that an enormous amount of people who look at this market are totally unaware of these underlying dynamics.
Yeah, absolutely. I'm interested in your comment, actually, about the short position in hedge funds, that they tend to be short on a more leveraged basis, I think, if I can sort of just summarize what you're suggesting, than the longs. Now, at the moment, there are huge short positions on COMEX, if I can switch to that market for a moment. And this would suggest that if the gold price starts rising, then we could well find that there's, if you like, at the very least, an enormous amount of embarrassment amongst the hedge funds who've shorted gold on COMEX, and it could well be that they become stopped out. Do you think that's a possibility?
I think it's highly likely, and I think it's partly due to the fact that a lot of them have made a lot of money out of this trade. And I think that, seeing as they're able to, even the most hubristic hedge fund manager will recognize they're not probably an expert in the gold market, having made a lot of money piling in the shorts. I think that they will be quite trigger happy to unwind. I think there is still sense from a number of people who've been doing it that they can get the price lower. So I think that there is quite a bit of fluff there that could be rejected quite quickly. I think what's more interesting in a way, Alistair, is that I think you and I and probably quite a few people who listen to this will be of the view that exactly that will happen, that some kind of short squeeze is likely. Exactly what scale, I'm not sure. But what I find interesting will be the reaction of the press to that happening, because the chat has been that this is a genuine bear market and a real sort of people are selling gold. And of course, you and I know differently. But and what I'm going to be interested to see is how they react to gold $300-400 in a relatively short time frame. What will be the reaction of the press to that? Because I think that they will be rather baffled by, of course, it is a short covering move, which really in fundamental terms isn't that exciting. But I'll be fascinated to see how the market takes it, the broader market, which may not spend as much time looking or thinking about this as a subject. But I'm reading a lot of articles at the moment about from sort of broad investment management types who really, again, don't specialize in the sector, saying things like, well, of course, gold's fair value is 250. I'll be shorting it all the way down there. Anybody that thinks otherwise is crazy. And it's interesting that down at these levels, these articles are starting to come out. And I would tend to say it's got to be the inverse of we're going to $30,000 an ounce in the next 5 minutes when we're way above moving averages. It's sort of similar. Analysis of a similar ilk, in my view. Yeah,
it's justification of trend chasing, if you like. Indeed. But what's interesting, I think, and this is something else that comes out in your paper, is that by driving the price down, the increase in demand for physical, in the sense of gold moving from west to east, which is the subject of your third chart, is something which you and I think, are very much aware of, but it doesn't seem really to be covered that much in the market. And here we're talking about the real physical actually disappearing out of, London and New York's control entirely. I mean, they must be getting very, very short of the physical, and this must be creating something of a crisis.
Yes, I think that's right. And I think also, there is a sense that the broader market sees gold investors as having cried wolf too often. And they see the current price action as proof that we're not worth listening to. So once you see the kind of price action we've seen, and then suddenly you see this dynamic of people paying 25% premium for physical in Delhi, which is just completely mind-boggling in real terms. But once you've seen the kind of price action we've seen recently, the people that might otherwise have listened to something like that, they consider the gold bug view of the world to be somewhat discredited because of the price action. Of course, actually, what's going on is really the gold bug view has always been that the price discovery mechanism is completely false, and that what needs to happen is it needs to be reformed, and that's exactly what's happening now. It's just it's happened in a falling price environment, which means that people are reluctant to listen to what one might say at this point, having seen the price come off as much as it has.
Yeah, absolutely. And I keep on pointing people to the experience, if you like, of the buyers in the Far East, and that is that they're used to their own fiat currencies effectively going down pretty consistently, and this is certainly the truth in India. Yet the Indian demand has been absolutely enormous and has coincided with an acceleration of Chinese demand. Yet the Reserve Bank of India, which you mentioned in your article, is now trying very hard with the government to control these gold inflows. I understand that they're trying to promote ETFs. They're trying to promote something called e-gold, whatever that is, E for electronic, I guess. And at the same time, they are trying to restrict the inflows of physical. Do you think that this is going to have any impact on demand for gold over a period of time?
Well, in Asia, no. I think that, frankly, I think that in the West we're so much more mediated than they are over there, and I think they're much more sceptical of the state. In Asia, they over a long run, they recognize gold as money. They recognize that the state will tell them one thing and they should be heading the other direction. And I just think it's a different dynamic here, where we've benefited so much in the last 50 years in the Western world from in a financial sense, or certainly the top half of the population have, that they're much more willing to listen to statist commentary on financial markets. But I don't think that's the case at all in India. And of course, I very much believe it's causing the opposite problem. I mean, you bear in mind, if you're paying 25% premium for physical in Delhi, jewelry, etc., that really is the equivalent of you or me walking to our cash machine, asking for £100, getting a receipt saying you've taken £100 out of your account, and actually only getting £75 in cash.
Yes.
Because that is a fair analogy. I mean, that is what it is. Mm. And I don't see how that can be anything other than an absolutely profound sign of the fact that this market is now, I think it's now broken, I suppose, because I can't see, Indians going back to paying 2% over anytime soon. I don't think that's where we are. I think the market dynamic has changed dramatically, as of course it did towards the end of the 1960s, the end of the gold pool. And I think, the open market price was $45 an ounce versus $35 at that point, when Nixon's bluff was called by Charles de Gaulle. And we're already approaching something of a similar discrepancy between the price on the screen and what one might describe as a real price. Of course, what we're talking about here is a localized real price, but a subject that you're interested in, and so should everyone be. But I do think it's interesting, and I think we are heading fairly soon towards something taking place, particularly obviously if you're further east than Istanbul, that's where the central bank purchasing has been coming from as well. So I imagine that they will be less than amused by the price action that we've seen and the true nature of it, i.e. the lack of physical that has flown behind it. So I think that there's some important dynamics going on, and I feel that we're probably not that far away from some kind of important resetting moment in precious metals markets. Exactly what that will be and how it will roll out, Alistair, I have no idea, but I do think it's likely to be into a substantially higher price environment. Yeah,
so I think to summarise, what we're looking at is a situation where the physical bullion basically isn't there to back an enormous paper market. We know from the technical position in COMEX what the situation is there, and that is that the hedge funds have shorted it hugely, and one would guess that they've probably done it by selling forwards in London as well. Mm-hmm. So we possibly are on the verge of really quite a sharp move upwards. Would you think that's a reasonable conclusion?
I do. But it's this great thing that one has always known as a gold bug, which is that when this happens, it's going to have very far-reaching consequences for the financial architecture. Something which I've been trying to explain to clients and to people I talk to with respect to the recent price action is to say, look, there are only two things that value money. And we know that the monetary system is broken. These currencies are worth 1-2% of their original purchasing power. The the monetary system is where the problem is. And the only two things that value money are interest rates and gold and silver. Yeah. And we know for a fact that the entire interest rate market on every level, from government bond yields to LIBOR to ISDA fixed to, I go on and on, that they are all openly managed, and no one would argue the toss on that. That's just the nature of where we are in financial markets. But the thing I find interesting is that there's no price effect on people admitting that behavior. You noted, with LIBOR, ISDA fixed, these stories come out, but nothing moves on the screen. Now, of course, the thing about gold and silver is the terminal market, and that's the point and the problem and the reason why it can't be admitted, because here we have a terminal market which will have real, frankly, fairly powerful consequences for the financial architecture once the cat is out the bag. I imagine that this would even extend to sort of G12 policymaking level. I can't imagine this has not been discussed in quite considerable detail, because if you and I know this, you can be confident there are people in central banks who are similarly informed, despite their behavior. They must be informed on this. They must understand this, and things must be happening in the background.
I think there's the old Chinese proverb: the wise man sits on the hole in the carpet and hides it from the visitor.
I've never heard that. I like that very much.
Anyway, well, it's been fascinating talking to you, Ned, and I'm very glad that after the merger with Quilters that we can talk about gold and silver again, and I hope to do this again shortly.
Not at all. It's a pleasure, Alistair, and absolutely, let's do it again at some point in the near future.
Indeed. Thank you very much indeed.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our gold research section.